Good morning, ladies and gentlemen. Well, nothing much has happened to the risk dial this week. It closed at 36, which is, a decent score. We are in risk on in all time frames. Don't forget that this actually is a measure of what you should prefer, whether it should be equities or fixed income. Not what is going to go necessarily up, but where you're going to lose the least money, kind of thing. So if we look at what the scores did, we opened the week at 30 and we closed it at 36, which is good. These moving averages are still moving out as opposed to stationary, but they're moving out at a very slow pace. And on the weeklies, same thing here. We only improved by 4 points on the week, but we are, as you can see, increasing the score week by week. So the risk dial is positive towards equities and more negative towards fixed income. Deviations continues to catch the market almost perfectly. We have a very slowly rising area here. It's very boring. I think every time it gets into the red it gets smacked back, but it's a period like this, a slow ascent of equities relative to especially relative to fixed income, and we'll have a look at the spread relationships later. But it is always subject to moves back down towards the middle line. We are very close, and we'll show you later on the monthlies, on the weeklies, we're very close to levels which are unsustainable without sort of backing and filling. Nothing that you would really want to be too worried about at the moment. But if you look at the various sectors, and I encourage you to go to the website and have a look at them, you will see that there are very few sectors which are really showing any kind of very interesting pattern. Everything is on a hold type of thing, slow ascent or a hold, and there are other sectors like XLK which are basically failing to keep up with the momentum that they had earlier and are subject to potential reversals. XLF again, it did what I thought it would do roughly last week. It got to the high 25s, but it really failed to go into the red. Not really surprising with Warren Buffett selling his holdings in Goldman Sachs and also in Wells Fargo. It's disappointing. Okay, there isn't a single sector which you can say, wow, that is really going to take the market higher. I think XLP is slowly ascending. XLY is dangerous. Again, nothing that I would really like to say, wow, this is it. This is going to take the market higher. XLI, I think, is also dangerous. I think the whole of the equity complex is in a holding pattern. Rotation is basically keeping the SPX index more or less where it is, still with that 3330 level in ES as so important. But I reckon it's going to be a very boring week next week as well. This week I would like to concentrate on the biggest surprise that I had last week, which is how aggressively the yield curve is moving. Now, the yield curve to me is going to be absolutely the best indicator of what is likely to happen in the autumn. and it always starts moving quite early, and then finally people realize what the yield curve has been telling them for, weeks, and a kind of panic ensues. This is quite a worrying development. These are 2s, 10s, and we are breaking out from this very important 53 odd level. Now it's at 56, it's not the end of the world, but it's just showing you that the yield curve is steepening even in the sector of 2s, 10s, which shouldn't really move, and not really, and we will look at 5s, 30s in a moment, and that's really worrying. We will show you the relationship between the yield curve and ultimately all the other asset prices. It is almost as if the Fed is beginning to lose control, or is not reasserting control. That is a very worrying development, because if the yield curve moves much more than this, an accident in equities is almost inevitable at some stage. I'm not saying it's going to happen this week, next week, even this month or next month, but I will show you what happens when the yield curve starts steepening and there is very little room for the short end to keep on going down, because interest rates are almost at zero. It could really turn into something very nasty and volatility could start spiking, but that is for later on this year. I just think it's very noticeable that the best position to have at the moment is probably for a continuation of the steepening of the yield curve. And this is the most critical part of the curve, the 5s, 30s. This is a daily chart. Now you'll remember last week I said, the yield curve will steepen some. It'll go down to this critical area around 105 basis points, okay, even to 109. So what did I do? I got long 5s, short 30s, was all happy, took off the last of my position at 105.5, and it just pissed through me. I was very surprised by the aggressiveness of the steepening. Now, has it gone too far? Maybe for a couple of days. Maybe we get another chance to see this kind of area again, to reshort it. But this was, to me, a very great surprise. I know we had the 30s auction last week, which went badly, at my surprise as well, because normally they cheapen up the market and then manage to rally it after the auction, even if it goes badly. But this time they've rallied it almost nothing. And it closed basically at the worst prices of the week. This is beginning to get worrying, because if we go through this 122 area down here, which the previous low was, all hell could start breaking loose. So, this is a very worrying trend. If I was the Fed, I would be worried and I would be defending it. Let's have a look at how it looks on the weeklies and how it looks on the outrights. Okay, so back to 5s, 30s on a weekly chart. You will see how impressive that move was this week, and how dangerous this looks. Because if we start going through this 122 area here, which was the lowest close back in whatever that was, March or something, we are really in for a world of hurt, because I don't think anything before this level, 139, 140, catches it. So if the yield curve is going to steepen another 30 basis points, it is going to start really reflecting on the maximum multiples that equities can show, and it's going to really hurt for technology and other interest rate sensitive sectors. But let's concentrate on when the yield curve started steepening, and that is basically in July of 2018. This is basically it. You know, July 2018 was the flattest the curve has been, and what a good forecaster it was. And now the steepening, what is that telling us about what can potentially happen to other asset prices in the weeks and months ahead? To me, this is worrying, okay? If next week we don't go back into this box around 105, 109, and we continue to steepen, really basically nothing before 140 and probably 154 catches it, and that is an acceleration, and that could have very profound implications for all asset prices. This is a daily chart of 5-year yields. As you can see, there's really nothing to write home about here. We have basically been in a very narrow trading range for a very, very long time, and that is because, let's face it, the Fed has told us so many times they're not going to hike rates for a long time, and really there is no danger in buying the short end, the twos, the threes, the fives. Those are the ones that are going to move least. Basically, in the last 2 months, we've done absolutely nothing in terms of yields, and that is the way it's going to be. I'm showing you this because the danger isn't in the twos and fives. You know, they could move up another 10 basis points, something like that. Could they go to 37, 38 basis points? Of course. But that isn't really the danger. A, because equities are not priced off them, and B, because you know, if this moves 10 basis points up and the curve is steepening, then long bonds are going to move 30, 40 basis points, and that is a big deal for equities. So just keep in mind that if you have the 5s, 30s on, the least amount of money that you're going to make or lose is going to be in the 5s. The real move is going to happen in the 30s. And this is the 30-year yield. I would argue now that any move above 148, 148.5 is probably going to take us up to here and some sort of a gap fill. That's around 166, 167 basis points, and the 200-day moving average, which is, you know, a decent move. 20-odd basis points in the 30-year. That is pretty nasty because it's going to happen quickly in a couple of days. That's enough to get people really, really worried about what's going to happen next. Certainly, while we are well below this downward sloping, very downward sloping 200-day MA, it's not very worrying. We could go there, bounce back, but then the situation starts, what happens next? Because if we are now completely rejecting this 120 basis point level, you know, sort of 115, let's call it, if we are completely rejecting these levels, that only leaves the upside open, because we all know that there's going to be much more funding pressure to come, and eventually the market just busts through and keeps on going, and I would argue really that we go all the way back up to 235. You know, that is going to be very, very significant, but this is a long way ahead. Let's concentrate on what's likely to happen in the next couple of weeks rather than what's going to happen in the next, you know, 6 months. This is beginning to be a worrying picture for me, because if we don't hold 148 next week, 149, I think we are likely to go straight for this gap fill here around the 165 level. The picture in TLT predictably is much the same, but the levels are even clearer here. 162.05. You know, we've got multiple weekly lows there. We start going through there, you know, it's going basically somewhere to here, 157. And then at some stage to the next really important level, which is 149. That could it be like an ABC retracement for the chartist? Yeah, sure. But that is enough to cause mayhem in other asset markets. That kind of a move would be what nobody is expecting or predicting, simply because you've seen how much money has been put into bonds in the last few months, how much flow into bond funds there has been. It's been hundreds of billions, and the market is saying something completely different. When people realize what the market is saying and what the relationship of the bond yields and the curve to the multiples in the equity markets is, there's likely to be some panic, and we can have a look at that next. Okay, this is a monthly chart of SPX, and I just wanted to go to where the yield curve started steepening, which is right here in July 2018. This is where it stopped flattening, and basically then we had 1-2 months of slightly higher prices, and boom, straight back down. That's because a steeper yield curve necessarily implies higher long bond yields, and that is basically a multiple compressor. When the multiples need to go down, even a going from times 20 to times 18, that is a 10% move. That is a 10% move in the SPX, unless earnings start increasing. In this environment, we're not going to get increasing and massively increasing prices and forecasts of profits, simply because we are not in that kind of a position. I think at some stage, you are risking, if the yield curve keeps on steepening, and that's why I think it's so important that we look at what happens next week to the yield curve and those levels. If that happens, I'm going to start getting much more defensive, and I will be a buyer of put protection, simply because I don't think that the market can withstand much more than 1 or 2 months of slightly higher prices. You can see how close we are actually to the top of the Bollinger Bands, and that is always on the monthlies a very, very bad news. We can stay above it for a bit, but eventually we come straight back down to something like this kind of level, 3080, the first moving average or the second moving average. That is what has got me worried. It's not an immediate worry, but it is something really to keep one's eye on. Another surprise for me last week was how stable the relationship was between the European yields and the US yields. With US yields rising, I thought that really this would be much higher than it is, than it closed the week. Which shows really that the trend in higher yields is actually a worldwide trend, and even more worrying. We are not at panic stations. Panic stations would be 125 and higher. But what I'm trying to say is that really the all yields worldwide seem to be going up. Why that is, why it should happen right now, I don't have an answer to, but it seems to me that the dollar is becoming key also, because you have the differential is going out and the dollar is not benefiting. What doesn't happen is just as important as what does happen. We'll look at the dollar next, and other asset classes like gold, which got hit because of the steeper yield curve. It's all getting to be in a position that is starting to scream, be careful about the bond market. Now, the weakness of the dollar was a bit of a surprise to me last week. I would have thought that with the yield curve steepening, it would necessarily imply a little bit of a squeeze in the dollar, and I was looking for it to go back towards 95, and that would be a wonderful level to reshort it. It absolutely had very little upside, apart from like Monday and Tuesday, and then it just gave up everything and a little bit more. That is a weak market, okay? So a couple of closes below 92.62, and this is going to start looking ugly again for the dollar. I have no idea why, but that is what the market is saying. I just don't understand why the dollar is this weak, and maybe the weakness of the dollar is what has the bond market worried. And that is why people are steepening the yield curve. They're abandoning the long end. They're saying that long yields in negative territory are unsustainable. Well, if that is the case, that has price implications for all asset prices. Higher bond yields are not going to be liked by anything. And really, if that is the case and the dollar starts breaking 92.62, and this is like a, I don't know, a 10-year trend line, not that I sort of really care about the trend line, but it's another indication. To me, these boxes, these trading boxes, are much more important. If we start breaking all of this, really we are looking for, you know, longer term 88 and a half, 89 as being the target from that kind of a move, and that is a big deal. That is certainly a big deal, and it will be a big deal for especially for gold, but for bonds and for all sorts of other asset classes. Now, gold is actually caught in between the tug of high real yields, or less negative real yields, and the weaker dollar that we saw last week, and which could continue. And that is the only thing really keeping it up. But if the dollar now started to strengthen, I think 1765, 1763 is almost a given in gold. Gold just cannot take higher yields. It is so stretched, it's almost ridiculous. And really, I would not be surprised to see a repeat of this, which happened, you know, months and months of trading in this spot between 1750 and 1950. That would be not surprising to me in the slightest. So really, gold is caught. It depends who wins. If next week we start seeing a steeper yield curve, and I've shown you the levels both in 5s, 10s, 30s, if those start getting broken and the curve goes much steeper than we've seen, I think that it's almost a given that gold next week trades down to at least 1800. Okay, that would not surprise me in the slightest. This kind of 1800 level is probably very good for a bounce, but probably that's all it's going to be, an A, B and a C back down towards the 1760 level. That is really the kind of level that I would be looking to buy it next. I think these two charts are going to be key going forward. Okay, this is TLT over gold, i.e. bonds over gold. This is very significant that for a couple of weeks now we've been closing below this very, very important line. This to me indicates that bonds are going to be weaker than gold, and that would indicate that the dollar is also going to break down. Why that would happen, no idea, but you know, that is what the indication is. There's only two ways that this can happen. Okay, either gold now starts going up and bonds remain stable-ish, or yields start going up quite a lot and gold starts going down less than yields are going up. So that to me is indicating that it's a time to not favor bonds at all because of this second chart, and we can see that we are the SPY over TLT, we are headed higher. We've just made a new weekly high, and we are going to this area around the 220 area where we were at the beginning of the year. So both charts of the asset classes are showing that bonds are the worst and that you should avoid them and short them and trade them from the short side. Now, quite how the relationship is going to play out, whether it's going to be bonds doing next to nothing and the other asset classes appreciating, or everything going down but bonds going down the most, is a moot point. I'm just trying to show you that really we are in a period where fixed income is a sell on rips, and the other asset classes are a buy against it. And that is really all we need to know for the time being. We don't need to really worry about the why, we just need to know that that is the direction of the trend. On the other hand, what is also very true is that we are going to get to some unsustainable levels in these spreads, especially SPY TLT, and that accidents down will happen, and that'll be a quick 5-7% move down in equities, while bonds do a little bit better on a flight to safety, i.e. it's not going to be a one-way street. Do not get enamored of equities, because at some stage multiples readjust, and that implies nearly a double figure move for equities, especially with these very stretched multiple valuations. There is no doubt in my mind that a steepening yield curve is bad for technology. Technology has basically become a type of bond. Apple seems to be a non-sovereign bond with growth. These levels are so clear. Okay, QQQ over SPY, a break of this 0.7972 level gives us very quickly this 0.7646. And that is, a 3% relative move that you can catch very quickly. That is what I'll be concentrating on next week. I have no doubt that actually at some stage will happen. It's just a question from where. Technology is very overstretched, and it can very quickly give up 3 to 4% relative to the S&P. And the S&P will not be going up at that stage. So that is a relatively large move, and this is something that you should really look at. It's very, very important, and that, I think, is where you will see the effect of the yield curve probably occur first. For those of you who only look at the outright in SPX, it's doing absolutely nothing wrong. On a weekly basis, I think we have the chance to take out these all-time highs and get people long. It's almost inevitable now that we will be in the 3400s in the next couple of weeks. But as you can see from a daily chart, the market is really doing very little wrong, and it is slowly going up along these moving averages, and the Bollinger Band on the daily seems to be containing it very well. Sometime next week I fully expect them to take out the all-time highs just below 3400, and just to piss everyone off and stop everyone out. But to me it is becoming dangerous up there. I'm liking the market less and less, but it's doing nothing wrong, and I'm not going to short it until it does something wrong. To me, this 3,337 level is still pivotal and crucial in SPX, and I will not short the market while it's above there. There seems to be absolutely no point. But if it does break there, I think the next, the place where it would trace to is still this 32.33. So that's a good 100 points. Okay, so that's a 3% move, and that is really what you can expect, and probably a lot more in NQ, given what I just showed you about the relationship between SPX and the Qs. So that is really what you have at the moment. You have a slowly grinding up summer market, which will inevitably take out at some stage the 3400 level and get everyone long just in time for a nasty move back down towards this kind of 32.33. The timing will be given to you. It'll be a break of this moving average and the level of 33.37. From now on, I'm going to put this table in at the end of the videos so you can see the levels, and it'll be a good summary for you, and you can just print it out and have it in front of you all week. I think the most important part of what to watch next week will be these relationships. These are the ones that have me most worried. If we start now going towards this 122 level in 530s, and God forbid breaking it, something very bad is going on, and I don't know what. This is also crucial in the absolute level, the outright of 148.5 in 30 years. I would be shocked if we break it. If we break this, we probably break that, and that is going to lead to some very, very nasty things. There you have it. I think that if this starts moving, this will be the result. Watch this level. I think you get a very quick 3% move, but from what I've shown you, I think it's pretty clear that I think that fixed income will be the weakest of all the asset classes, and really you are looking to trade it from the short side compared to these other asset classes. So when they dip, you buy them, you sell fixed income against it, and that's how you construct your spreads. Thank you very much indeed, and tweet you later.